think I might have accidentally hit recording as well. I don't know if it's affected anyone else's.
Good morning and welcome to BDO's Insurance Broker and Intermediary Update Call. My name's Alex Barnes. I'm head of insurance at BDO, and I'm absolutely delighted to be introducing some of our key experts from the insurance team. Firstly, we've got Charles Portsmouth, who's going to cover key regulatory developments going on right now, particularly with Brexit, COVID-19 and various conduct matters. Then we've got Tom Barford, who's been doing a lot of who's been doing a lot of M&A work with insurance intermediaries. So it's going to really draw out key trends from that side. And then we've got Thomas, Masuma, and Syeed, who are all going to cover tax developments and risks that the intermediary market really need to think about. A few admin points first of all. Firstly, this is being recorded, and slides and recording will be available later. Secondly, all lines are going to be muted. But please do submit questions via the Q&A function. Well, without further ado, I'll just pass you on to Charles Portsmouth. Over to you, Charles.
Thank you, Alex. Good morning to everybody, and thank you for joining us. My task this morning is to look ahead at the regulatory agenda for the next 12 months or so and see what might keep compliance officers in your firms busy. I'm going to do this through the following lenses. Can we move the slides on, please? I'm going to use this through the following lenses or key drivers of activity. Firstly, Brexit. Secondly, the current hiatus around COVID-19. And lastly, what was on the FCA's agenda and was delayed, and what might be on the agenda going forward. Some of it is grabbed from the regulatory initiatives grid, which was recently reissued, and some of it comes from elsewhere. Turning to Brexit. What has happened since 31st of December 2020? Well, just prior to Christmas 2020, the UK and the EU announced we had a deal and we left at midnight on 31st of December 2020. Equivalence for financial services was a goal, but this didn't happen as part of the UK-EU withdrawal deal, and instead a deadline of March 2021 was set as a deadline for a memorandum of understanding for going forward. In March, it was announced that this had been agreed, but no text has yet been published to my knowledge. Equivalence, therefore, still some way off, and maybe, if ever. This matters less for brokers, as the IDD had no equivalence provisions, unlike Solvency II for insurers. So the regulators have been busy setting out memorandums of understanding with the EE states for regulatory cooperation. The FCA have confirmed firms seeking authorization in the UK will have to meet the same standards as everybody else, including those FCA threshold conditions. And lastly, the government has been consulting on the future of regulation through its regulatory framework review. This looks as if the outcome will be that what is currently UK law, such as the Solvency II Directive and the IDD, etc., will be transferred into the regulator's rulebooks and removed from the statute book. This allows the regulators to vary the rules, much more quickly than is the case if it was needing to be changed in law. And this will be a key difference going forward between the UK and the EU's approach to regulation. And this might well endanger any equivalence agreement with the EU as we move away from their preferred method using legislation. Looking now at COVID and the effect on the regulatory agenda. Much of what they had been planning for the year was delayed and firms were given some leeway. For example, the final implementation of the senior managers regime for solo regulated firms was moved by 3 months from December 2020 to March 2021. And the pandemic has focused the regulator's mind from an insurance perspective on 3 particular areas. Firstly, vulnerable customers and the need for ensuring that treating customers fairly in this area by ensuring the financial services industry took into account the extraordinary circumstances in their treatment of customers being unable to pay, etc. And I will suspect this will continue to be an extra focus because of the research that some sectors of our society have been much more affected by the pandemic than others. Secondly, the FCA took unprecedented steps in the well-publicised arguments over the cover provided by business interruption policies underwritten by some insurers. The contingency market has been heavily hit by the losses incurred, but claims were relatively easily made as the event either happened or did not. The BI claims were much more nuanced by the specific terms of the wording of the clauses contained in the policies, which also varied between the insurers. The FCA has probably ensured that claims have been more speedily settled, for many, by their actions. However, I'm sure that this issue is going to rumble on from some time to come. And lastly, both regulators have been worried about operational resilience, an area that has been on the regulatory agenda for a number of years, but which has been brought into sharp focus by recent events. And this is culminated in the issue of March of this year of both regulators' policy going forward in this area. The FCA released Policy Statement 21.3 on operational resilience. So let's look at operational resilience in a little more detail on the next slide, please. The deadline for compliance is 21st of March 2022, a little under a year from now. Core FCA solo regulated firms can breathe a sigh of relief because it does not apply, and I assume that most attending today will fall into this category. You just need to worry about meeting the existing handbook provisions as set out in SISC. However, for insurers and enhanced FCA firms, it will cause much work. They have a year to meet most of the provisions. In brief, it requires firms to identify their important business services, and these are defined as those that might cause an intolerable level of harm for customers or pose a risk to the soundness of the financial system, such as, I guess, a breakdown in ATM systems, or I guess now the tap and run systems, such that money or the ability cannot be accessed in terms of paying for goods and services. It might be for insurance claim systems not being able to respond to customers and provide the policy benefits that they've been promised, such as the replacement car on a timely basis. And those firms subject to the rules will need to start mapping those important business services in terms of weaknesses and the time taken to restore them. They'll need to set impact tolerances for recovery of systems within, say, 24 hours. And they will define their monitoring tools and related metrics. And then they need to operate their business in accordance with those tolerances and metrics. This might be a big project for some firms and requires board buy-in, a budget, and a coordinated approach by all 3 lines of defence. Let's look at the FCA business plan next. The 2021-22 plan would normally be released in April, but has now been delayed until July. We have a new FCA CEO, and the FCA needs to respond to the criticism handed out by Dame Elizabeth Gloucester after she looked into the events relating to the FCA's regulation and supervision of London and Capital Finance, which entered administration in January 2019, impacting over 11,000 people who had invested around 237 million. Her report concludes the FCA did not effectively supervise and regulate LCF during the relevant period, and it made 9 recommendations for the FCA, focusing on how they should improve their internal authorization and supervision processes. The FCA is responding to this through its FCA transformation project, which, according to the FCA chairman in a recent speech, will make sure the FCA enforce the gateway to authorization, focus on the basics, focus on outcomes, and use the rulebook better and faster. It will reshape the FCA itself and its operational culture, and ensure the FCA states clearly the outcomes wanted, measure those outcomes, and be transparent about whether the FCA have achieved them. And as usual, the FCA have been majoring on conduct and culture, the senior manager regime and its effect on a firm's culture, and how diversity might help that issue. Can we turn to the next slide, please? Oh, sorry. Yes, no, turn to the next slide, please. The recent dissentia of Alsford, Page and Gems underlines the continuing importance of firms dealing with conduct risk effectively and of responding properly to the FCA's concerns in this area. A recent Freedom of Information request noted that out of approximately 6,000 solo regulated firms of insurance intermediaries, only 15 conduct rule breaches by senior managers and certified staff were reported last year. That's less than 1%. 10 of the breaches related to certified staff and 5 to senior managers. If reporting remains lower than expected, the FCA is more likely to step in and investigate firms, and the industry as a whole may face more scrutiny in this area. The majority of the breaches reported were for integrity, followed by due skill, care and diligence issues. And integrity breaches might indicate that firms have more work to do in the terms of their culture and making sure their staff are doing the right thing. Firms should probably note that tick box training and too good to be true reporting, or the lack of it, will not satisfy the FCA. They've also recently started a consultation on a new consumer duty. On the next slide, please. Some years ago, they started their 5CQ program, or the 5Q conduct questions they asked firms. Apologies, previous slide, please. I'm still working through conduct. They're stressing a firm's purpose, principles, and values. They believe a healthy, purposeful culture should lead to better outcomes for consumers and markets, and healthy and sustainable returns for shareholders. And it should also lead to a healthier and less stressful environment for employees. And as such, they have welcomed the recent PRA conclusions on the overall effectiveness of the senior manager regime in terms of culture and accountability. They have set out that they are moving from addressing tone from the top to tone from above. Do the lower levels recognize or hear that tone from the top? And also the tone from within. What does that mean for everyone's behaviors within the firm? And they're also addressing the diversity issue in terms of the reaction to those vulnerable customers identified, as I said earlier, as more severely affected by the pandemic. Their work with the PRA on this issue. The PRA have recently reminded firms of their diversity objectives and possibly making this topic a 6th CQ, adding to the current 5 CQs they currently use. So turning now lastly to the new proposals on a customer duty. Set out in a very recent consultation paper, they're proposing a new consumer principle to apply to all firms, the exact wording of which is still being discussed as part of that consultation. A series of cross-cutting rules apply to all firms regarding reasonable steps, a phrase that is used as part of the senior managers regime and in the senior manager rules regarding causing harm and acting in good faith. And this is underpinned by the 4 outcomes they're looking for products and services. The appropriateness of communications in respect to those products and services, the design of the products, the price being of a fair value for the services, and lastly, around customer service itself. This consultation is open till July, and should you wish to express a view, take the chance to do so. Thanks for your attention, and I'm now going to hand over to Tom Barford, who's going to take us through mergers and acquisitions, I believe.
Thank you, Charles. I'm an Associate Director in the BDO Transaction Services team, and I specialise in insurance transactions and predominantly in insurance brokers and intermediaries. This morning, I'm going to give an overview of recent market activity, also multiples, and also ownership of the UK broking market and what that might mean for M&A going forward. So go to the next slide, please. So this slide features publicly available market data on insurance intermediary transactions coming from Merger Market. In terms of the quarterly deal numbers on the top left, I think you can see that COVID-19 didn't have a particularly pronounced impact on the volume of M&A. And actually the impact of COVID-19 on M&A was far less pronounced than the impact of Brexit on M&A activity following the referendum in 2016. There were definitely quite a few deals which sort of during the second quarter of 2020 were delayed and put on pause, but the majority of these transactions were picked up and completed in the sort of back end of 2020. The impact of COVID-19 was largely to make deals slower to transact, largely due to short-term potential impacts on financial performance. And this generally caused deals to be restructured and just took longer to do so. Examples of this is where earn-out periods may have been increased in order to allow businesses to get back to pre-COVID levels of performance. So in terms of the big spike in Q1 2021, so the main cause of that, the first is concerns around increases in capital gains tax, which I'll cover a bit more on the following slide. And also general improvements in market sentiment following sort of the beginnings of the successful COVID-19 vaccine rollout. The second quarter isn't likely to be as down on the first quarter as shown in that chart. It's largely because Q2 is not yet over, and it does take some time for deals to be fully completely reported. In terms of the drivers of this large sort of 2021 level of M&A activity, we've obviously got large-scale M&A transactions such as the Aon Willis merger, which was announced last year, and there's also been the announcement of certain remedy transactions following that merger from the CMA, including the disposal of Willis Re to Gallagher's. But one of the most pronounced factors in the market over the last year has been a number of secondary PE transactions where PE-backed brokers have exited to other private equity houses. Examples of that are GRP, where Searchlight acquired a majority stake. Howdens received an investment from HG alongside other investors. Ardonna raised almost 2 billion in debt from Ares. PIB, Carlyle Group exited to Apex Partners, and Specialist Risk Group, Pollen Street Capital exited to HGGC. And this significant level of reinvestment in brokers has caused or has continued to contribute towards a significant level of M&A activity. Looking at sort of deal announcements from those brokers in 2021, GRP have announced 7 acquisitions, including Marsh's UK Networks business. Howdens have announced 4 acquisitions. Specialist Risk Group have announced 6 acquisitions, and PIB 5. So it certainly has had a galvanizing impact on market activity. In terms of the multiples, you can see on the right-hand side, I think these should generally be taken with a pinch of salt. There's generally, of the number of transactions announced, generally a relatively small number. So it's a small sample size actually have information available to sort of calculate multiples. And these are generally calculated on reported figures rather than sort of adjusted on normalized figures. So they're really unlikely to reflect the commercial drivers of deals. In terms of what's really going on in the market, I think myself and my colleagues are seeing the multiples for smaller brokers increase. This is generally due to continued appetite of acquirers, and particularly following significant levels of investment from private equity backers. And there is a reducing pool of UK-based target businesses. So there is certainly more demand than supply. For larger brokers, mid-teen multiples, EBITDA multiples are becoming relatively common. And they've been enhanced through these brokers positioning themselves as M&A platforms, which is where these businesses become fully integrated and are able to quickly and efficiently integrate sort of acquire businesses into the platform post acquisition. So we move on to the next slide, please. So this is a summary of the PCPI index, which is published by BDO on a quarterly basis, which covers all UK private company transactions. And what we're seeing here really mirrors what we've seen on the previous slide in terms of trends. So I think the insurance intermediary market in the UK is really following the overall trend in terms of private transactions. We can see that on the PCPI index on the left, multiples, average EBITDA multiples increased from 10.3 in Q2 20 to 12.3 in Q1 2021. And on the right-hand side, we can see that there were 776 transactions in Q1, which was actually the highest level for the last 16 quarters. As I previously mentioned, a really big impact, both in terms of number of deals, but also sort of experience on deals, is that CGT was a big driver of getting deals done on time, and it was a big contributor of that increase. And it's certainly possible that if there are future anticipated increases in CGT, this will also precipitate further accelerations in M&A activity. So if we can go to the next slide, please. This slide is an overview of the ownership of the top 50 UK brokers. And I've broken it down between listed businesses, including where brokers are ultimately owned by a listed business, where they're privately owned and where they're private equity backed. And sort of key headlines from this is really that obviously that listed brokers only contribute 16% by number, but contribute almost half full revenue. Second thing is that private equity investment contributes almost half of all of the top UK brokers, and that privately owned businesses represent 38% by number, which is still a significant proportion, but it's only 12% by revenue, which emphasises that the private equity, the privately owned businesses sort of sit in the smaller end of the top 50. On the graph on the right hand side, we can what we've done there is taken sort of the private equity ownership of the top 50 and segmented that by the year of the latest sort of liquidity event or acquisition. And this is the result of a continued shift towards private equity investment in the UK broking market over the last 5 years or so. And typically, private equity investors will look at a 3 to 5 year investment horizon, where after which the private equity backer will seek to either exit to another private equity investor, to a trade acquirer, or seek to list on a public market. I've already sort of set out a number of secondary private equity transactions, and we can see that has had an impact of rebalancing this proportion. I ran these numbers several years ago, and it was actually quite heavily weighted towards 2017, and that's really shifted towards sort of businesses which have been bought in the last sort of 24 months. And also, I think what we can surmise from this is that, that there are businesses which have been owned for 5 or 6 years by private equity. So I think it is likely that those businesses will start quite quickly to look to seek exits. More generally, these platform businesses have managed to successfully attract private equity investment. They've made a significant number of bolt-on acquisitions and have successfully exited to other PE investors. And this has generally led to that increase in the multiples applicable to platform brokers. One observation is that in order to sustain this current level of M&A and multiples, I think the future growth of these platforms is potentially likely driven by international opportunities on an increasing basis. And what we might see over the next 2 to 3 years is that proportion of sort of private equity ownership, may shift, and it really depends on the current level of private equity investment and where those private equity investors will exit to. And it is uncertain as to whether there's sufficient market capacity within trade buyers for all private equity investors to fully exit to trade. So what we might see are certain platform forms could merge, and you could see certain exits via IPO, particularly among some of the larger private equity players. So if we can move on to the next slide, please. So in terms of sort of key takeaways, in terms of what's been going on, I think firstly, the COVID impact on M&A has been less significant than might have been expected. Insurance intermediaries have generally been pretty resilient to the challenges faced, and deal flow hasn't been significantly impacted. And Brexit was certainly a more depressing feature on the M&A market at the time in 2016. And COVID-19 is providing opportunities for brokers to reset expense bases. I think that there'll be potentially rationalisation of office spaces, which will improve profitability potentially. I think a lot of brokers are looking to maintain a lot of travel and entertaining savings, where they will obviously go up from the 2020 base, but they may not fully go back to what the spend was in 2019 and prior. And I think lastly, the sort of move to electronic placement, which has been a feature of having to do business remotely, is likely to drive efficiencies, and businesses may look at how they're going to resource their businesses going forward in a more efficient way. Secondly, large broker M&A, particularly the Aon Willis transaction, will provide opportunities for smaller firms to attract talent from these businesses. I think this certainly happened when JLT and Marsh merged, but in the longer term, the merged business will there'll be a significant dominance in the market of the very largest businesses, and it may prompt an increase in M&A from the next tier who may seek to consolidate in order to compete. And lastly, I think the private equity M&A appetite is unlikely to change, particularly whilst there is sufficient opportunity and deal pipeline. As I previously mentioned, this may come increasingly from international opportunities. And I think the UK consolidators may look to those sort of major global insurance markets to do so. So I'll now hand over to my tax colleagues who will be providing the tax update.
Thanks, Tom. Good morning, everyone. I'm Thomas Tome, Insurance Tax Partner at BDO. Today, we will give you a brief tax update, including the developments from the recent budget, but in particular focusing on the additional tax reliefs that businesses can get. We'll also include a bit about Brexit, and of course we have to after the Eurovision Song Contest. And then we'll finish with an off-payroll workers, just a reminder of the new rules that came in on the 6th of April. So I'll hand over to Maz now, who will cover the corporation tax update.
Thank you, Thomas. So just a bit about me. My name is Masuma Rawji. Everyone calls me Maz. I work alongside Thomas in the insurance tax team, and I'm a senior manager there. So what we wanted to talk to you about today was primarily the budget, because there have been significant changes in the budget this year. And the last time they had such changes was in 2017. So it's quite important to actually go through this. Can I have the next slide, please? Perfect. So the main change has been to the corporation tax rate. So the trend has been where the corporation tax rate has been decreasing. So when I started my studies, it was at 30%. It's now at 19%, and it was due to go down to 17%. But the government have done a major U-turn here. So from the 1st of April 2023, the main rate of corporation tax is going to increase to 25%, which is quite large. And this is for large companies, by which we mean which have chargeable profits more than £250,000. The 19% still stays for small companies where the chargeable profits are less than £50,000. So between these two rates, the 50,000 and 250,000, they're going to have a marginal rate. And if you land in between here, you're going to pay tax for every extra penny at 26.5%, which is quite large, the marginal rate. So here, BDO can help you plan with group relief and stuff to reduce, getting off that marginal rate, because you really don't want to be there. One thing to keep in mind is these rates are prorated for short accounting periods, and they're also prorated for the number of associated companies. So if you've got 2 associated companies in a group, for example, the 250,000 becomes 125,000. So if you have chargeable profits of 125,000, you'll reach that 25%, quite quickly. Then the other thing we wanted to talk to you about was diverted profits tax. As you guys know, the UK has been fighting to stop profits being diverted to low tax overseas jurisdictions where there is no economic substance. And the way they do this is if your profits are diverted, they currently charge a 25% charge, even though your corporation tax rate is 19%. The diverted profits rate is 25%. Now, as the corporation tax goes up to 25% in 2023, the diverted profits rate is going to go up to 31%, just to keep this differential. So, so this is something you can talk to us about as well. Making tax digital. Now that's still coming in as far as we know. There was a consultation which ended in March, and the HMRC are actually putting together all these comments. So what's going to happen is before they release this, we'll sort of find out what happens, and we'll let you guys know. But as far as we know, it's still coming in 2025, 2026. Now, some good news. So I'm sure all of you have heard of this super deduction. I know a lot of my clients spoke to me about this. So the super deduction applies to capital expenditure, which has incurred from 2021 to 31st March 2023. And if you note, this ends just when the corporation tax rate goes up to 25%. And the reason it's come in is because as a corporation tax rate goes up, a lot of companies are thinking, well, we're not going to spend money right now. We're going to spend money later, when the corporation tax is high. We'll invest in our plant and machinery later. So what the government wants to do is they want to encourage you to spend the money right now, bring forward your spending in this COVID recovery period. So the way they're going to do this is they give you a super deduction. Now, the super deduction is what it is for all the plant and machinery spending, which goes to the main pool additions, there is 130% allowance, right? And for a special rate pool addition, there's a 50% allowance. So this is quite high. Now we can compare this to the 18% main pool and 6% rate for the special rate pool, which was there before the super deduction came in. This is also in additional to annual investment allowance, so it's quite good. Now, the key point is that even though the expenditure should be incurred after April 2021, the contract should have been entered after the budget date, which was the 3rd of March this year. So if you had a contract where you entered before 3rd of March, even though you may have spent money after 1st of April 2021, you may not get this super deduction. So you have to really watch out when you spend the money. So I'll give you an example of how it works actually. So if you've got, like, for example, a 10 million expenditure in a plant and machinery pool, you get 130% allowance. So this is 13 million deductible expense. At 19%, it's about 2.4 million tax effect. So in effect, you get 25% tax effect. Now, the things that are included are used and secondhand assets. and any contrived arrangements. Until last week, leasehold, properties, leasehold buildings, which would apply to property lessors or landlords, were excluded, but they just changed the rules. They did a U-turn on this, and these are now allowed. Now, in addition to the super deduction, as I said, the annual investment allowance is still there. So you get an annual investment allowance of 1 million. Now, this was due to end just last year in December, and it's been extended actually for a whole year to 31st December 2021. And this allows for us to help you plan a lot more. So let's say if you've got assets which are going to the special rate pool and you getting a super deduction of 50%, what we can do is we can say, well, actually, if you've still got your annual investment allowance left, we'd rather get 100% annual investment allowance on this rather than the 50% super deduction. So we can help with all that planning, when we do your comps and stuff. The other thing that they've got going is loss relief. Now, currently, loss relief can be, well, before the rules came in, loss relief could only be carried back for 1 year, and we'll call that current year -1. Now, this has been extended. So if you've got accounting periods which fall in from 1st April 2020 to the 31st November 2021 and 1st April 2021 to 31st March 2022, you can carry back losses for up to 3 years. So it's been extended, but there is a cap on this loss. So you can carry back a maximum of 2 million losses per year of loss for current year -2 and current year -3. So that you still have that unrestricted carry back for the current year -1, if that makes sense. So the maximum you can carry back is 4 million. However, there is a de minimis here. So if you've got of £200,000 per company, so if you've got losses of £200,000 per company, you can carry these back without restriction. So if you've got lots of companies with loads of £200,000 losses, you can actually carry them back without restriction. And this doesn't, add to that 2 million. So that's an additional amount. Now, there's a lot of admin here. Where the nominated company has to be nominated and they have to file a return. And again, we can help with this. The reason the Treasury are actually doing this is they probably want you to use up your losses right now before the rate goes up. As you can see, the loss is just for the 2 years before the rate goes up. So they want you to use these losses up. So when the rate goes up, you have more tax, because otherwise, people are likely to use this losses against the higher tax rate. So we can help model, which is more beneficial. However, you have to keep in mind that there is a cash benefit to, carrying losses back, and rather than, carrying forward. And with a 25% rate, they've said this now, but, there's uncertainties in there. Like, we don't know what's going to happen in the future. R&D. So R&D, the repayable credit was capped in the budget, and the amount it was capped to was 20,000 plus 3 times the relevant income. So this was actually capped. There was no cap before the budget. From 1st of April, this was capped. However, there is a lot of changes to R&D, especially SMEs. Again, this was capped for SMEs, but there's a lot of changes to R&D, and especially with more small medium, with the rates coming up. So there's a consultation going on right now, which BDO is actively engaged in. BDO has one of the biggest R&D teams in the industry, so we're actively engaged with the HMRC on this consultation. So if you've got any comments that you want to make or you want to talk to us about, please come talk to us, and we can sort of reflect your opinions in there. Anyway, the other thing we have actually is a benchmarking tool. So BDO have produced this benchmarking tool, and what we can do is we can benchmark your claim with other companies in the same industry. And we have this tool because we're one of the largest R&D teams, so we've got a lot of data, and we can tell you whether you're overclaiming, and HMRC are going to be looking at your claims a lot more closely, or whether you're underclaiming. And, there's a potential to actually revisit this and increase your claim. Now, DAC 6 is the next thing. And as you know, post-Brexit, DAC 6, which is actually the disclosure of cross-border arrangements, that was repealed by HMRC. So we all breathed a sign of relief when that happened, because it was quite complicated. The only thing left of this was the disguised beneficial ownership, where you've got offshore entities with disguised beneficial ownership. And this doesn't really apply very much in the insurance industry anyway, and brokers. But But that's the only thing that's left of it. Now, if you're planning, and this is very important, if you're planning anything with post-Brexit restructuring, please come talk to us, because we see a lot of issues and a lot of clients come talk to us after the event. So they'll come say, oh, we did this, and we can't really help you at that point. So if you come talk to us, we can look, we can help you with all this transfer price, diverted tax profits, and all this, all these things if you come talk to us early enough. So please do. We don't charge you for talking to us, so please do that. ESG. Now, ESG is big on the agenda right now. And what it is the environmental, social, and governance agenda. And there's an increasing focus on this, where companies are embedding their ESG agenda in their company strategies. So, so in terms of tax, organizations are looking at their tax footprint as part of their economic contribution and tax responsibility. And again, this is becoming a big priority, and it's mentioned in the World Economic Forum. And again, we have a large ESG team, so please come talk to us. We can help you with this. We're actually quite at the forefront of this. It's very active and ongoing. Now, I've talked enough about corporation tax, and I'm going to pass you to my colleague Syeed. He's going to talk about VAT.
Hello. Thank you, Maz. And as she said, I'm a senior manager in VAT. I specialise in the insurance area, and I wanted to talk through a few sort of hot topics and opportunities. I'll be talking a bit about Brexit and impact on partial exemption, go through establishment and cross-border issues, making tax digital, a little bit on COVID, and sort of updates on insurance intermediary exemption. So beginning with Brexit, there's sort of a welcome news within the FS and insurance industry, in that HMRC have allowed for specified supplies to be extended. So just a bit of background: prior to leaving the EU, specified supplies would mean that supplies that would have been exempt, insurance supplies that would have been exempt, you're entitled to VAT recovery if it's supplied to someone outside the EU. So UK and EU would have been non-recoverable, but post-Brexit, so post 1st of January 2021, supplies or insurance supplies made to EU customers would also entitled to VAT recovery. So specified supplies now extends to anyone outside the UK. There are a few practical considerations to think about. So prior to Brexit, HMRC's initial policy was that any input tax incurred prior to leaving the EU, but relates to supplies made after Brexit to an EU customer, would not be recoverable. However, they have, after leaving the EU, they have revised the guidance, and such input tax incurred prior to leaving the EU, but relates to supplies made to an EU customer after leaving the EU, would entitle to VAT recovery under your annual adjustment, provided your VAT, the year that the cost was incurred is after 31st of 11 p.m. 31st of December 2020. However, word of caution, on the flip side, if your insurance supplies were made to an EU customer prior to Brexit, but you incurred costs after Brexit, for example, you've got a EU customer, but you're dealing with claims handling and you're incurring claims handling costs that you've incurred after Brexit, then these costs would not be recoverable. So sort of making sure you keep an eye on the costs, and so if you're unsure, then do let us know. Other practical things is do you need to submit a new partial exemption special method if you've already got one and they agreed? Does it need to change to say that okay, now supplies made to EU as non-EU is recoverable? The answer is HMRC has passed regulations to allow businesses not to do that, so they can rely on the existing PESM, the partial exemption special method, and read non-EU to be non-UK. However, a word of caution: we have seen HMRC in our experience sort of refuse the requirement to use the existing PESM specific types of PESN. For example, if the PESNs use location of customer as a proxy for recovery, then we have seen HMRC refuse that. So prudent would say, as a measure of prudence, to feel free to speak to us if you're unsure about whether your PESM needs to be reviewed or updated. Another reason to review your PESM is if you use a prior year recovery method for the current year and then do a true up on an annual adjustment basis. Because prior to Brexit, your recovery would be a lot lower, and after Brexit it'll be higher because you'll have EU businesses that will drive up the recovery, but you're stuck using the prior year's recovery, the lower recovery, in which case HMRC policy is, okay, you'll need to submit a new method to unlock that cash flow. But if you need to unlock it, or if you prefer to wait until the annual adjustment following year, then you can retrieve the VAT when you do your true up. In terms of anti-avoidance and offshore loops, so this is relating to insurance supplied to, or prior to Brexit, to a non-EU, for example, Gibraltar insurer, but the underlying insured party is in the UK. The anti-avoidance rules is to say that input tax in relation to such supplies would not be recoverable anyway. So if your insured party is in the UK, it doesn't matter where the insurer is, whether it's in the UK, EU, or outside the EU, input tax is still not recoverable. So the extension now means that if the insurer is based in the EU, but the customer is in the UK, then no input tax is recoverable. And I guess in terms of restructuring, so, with passporting rights and taking advantage of being able to market into the EU, a lot of businesses may set up an EU hub. And there may be service agreements between the UK and the EU. And the question is, okay, A, what's the VAT liability for service? And B, from a UK partial exemption perspective, does that constitute a change in business activity? And therefore you may need to review and resubmit a new PESM anyway. So, we've been assisting a lot of businesses on that. And if you have got a new, or if you have undertaken restructuring, then it's worth just letting us know, and we can take a look and advise accordingly. Moving on to establishment issues and sort of cross-border matters. So a recent case, recent ECJ case on Danske Bank is regarding transactions between two establishments of the same entity, with one of them being the VAT group. So it's essentially a part two of the Scandia case. So bit of background. Transactions between two establishments within the same entity would normally be disregarded by what Scandia has said. So Scandia is regarding an EU establishment of a non-EU head office, and that EU establishment is in the VAT group of that EU country. And what the ECJ has said, that transactions between two establishments, one of them being in a VAT group, is to be treated as a supplier for VAT purposes because they're two different taxable persons. So as a result of Scandia, many countries have adopted that position. However, some countries, UK being one of them prior to Brexit, have not adopted Scandia and considered that if an establishment is in a VAT group, then it's treated as the whole entity being in the VAT group. Now, following Danske Bank, which reaffirmed Scandia, many countries that haven't adopted Scandia may review its position. So the advice is, if you've got establishments in a number of EU countries, and some of them are in a VAT group and there's transactions happening between them, then it's worth getting that reviewed. And we've got a good network of BDO International and offices in the EU that can look into that. And question is, does Scandia apply if that country has not adopted Scandia? Is there a risk that they might do so in the future? And is there ways to mitigate any irrecoverable VAT? Next is quickly on the upcoming HSBC case regarding an overseas company having a UK establishment, the UK establishment being in an HSBC VAT group, and sort of routing services from the head office to the VAT group, which is beneficial for VAT purposes because UK hasn't adopted Scandia, and suppliers would reduce the VAT payable or reverse charge payable. However, what HMRC are now challenging on with FS industries and insurance industries in general is whether the UK branch is really established in the UK. So for an establishment, a business will need to have sufficient human and technical resources to operate on a permanent basis and to operate independently. And what HMRC's sort of shift in stance is that if the UK branch is not making supplies to third parties, if it's just supporting the head office, then it might not be operating independently, although work is done outside the UK. And what it's looking to do is retrospectively argue that, well, the VAT group the branch shouldn't have been in the VAT group anyway, retrospectively, thereby creating a tax charge. Now, if HMRC lose on the argument, their second bite of the cherry would be that protection of revenue powers. So, okay, even if the establishment is legally allowed to be in there, they'll say, well, we think that the whole arrangement is done for tax avoidance reasons, and therefore we will cease VAT grouping from a current date. So it's a topical area, and definitely something that we've advised on. And if you've got some similar sort of arrangements, do let us know. The other thing, moving on to the next bullet, sort of flipping it around and say, okay, if you've got overseas establishments, whether HMRC would seek to bring those establishments into the UK and deem these UK established for VAT purposes, again citing human and technical resources. So you need to have sort of sufficient substance in those countries to be able to be deemed established in that country. The implications being, if it's deemed to be UK, then potentially you've got a UK VAT charge or an irrecoverable VAT. If an exempt supply is made between a UK company and a UK establishment of the overseas entity, then potentially irrecoverable VAT there. So again, something we can look into. Making tax digital for VAT. So just quickly, for periods starting after 1st of April 2021, businesses will need to ensure that its processes are digitally linked. So from the source data to the final VAT return numbers, there needs to be, all the links need to be digital. You can still use Excel, but you just need to ensure that the formulas are done properly. And of course, partial exemptions do not have to be part of the digital journey. You can do a separate spreadsheet for that, but the adjustment figure will need to be included in the process. You may wish to consider in the future, and also considering corporation tax, making tax digital, a more automated solution, a more like all-in-one solution in the future. And we've got a tax technology team that sort of specializes in that, so do let us know on that. Quickly on COVID-19, so last year around Q2 2020, many businesses have deferred paying the VAT. These need to have been paid by 31st of March 2021, or failing that by 30th of June 2021. So HMRC are not going to charge penalties or interest if you pay by 30th of June 2021. You can opt to pay in installments. You'll have to apply by 21st of June 2021. You do it through your government gateway account, in which case payment is spread over a number of periods up to 31st of January 2022. Or failing that, if you're struggling to pay, then you can arrange a time to pay arrangement with HMRC. We've got a team in the firm that sort of helps with that as well. And just quickly on sort of updates on insurance intermediary exemptions. So these are quite grey areas in VAT. There's always a question mark on, you've got a new product, is it exempt or is it taxable? So this case, Q case, so what's called Q, they licensed some software for an insurance product to insurers. They also provided sort of customer matching and claims handling services as well. And the case regarded is it single multiple supply, and what's the VAT liability of it? Now, in this particular case, without going to technical details, the court considered that what Q was doing is a single supply of taxable software licensing supply. Now, the case is quite fact specific. That doesn't necessarily mean that if you're supplying technology, it's automatically taxable. If it's got the characteristics of acting as an intermediary capacity, then it can be exempt. So it's a good opportunity to, if you've got technology, or if you're buying technology from an overseas supplier and need to know whether it's subject to reverse charge, to get that reviewed, because it's a sort of grey area on that. So that's it for VAT for now, and I'll sort of hand it over to Thomas to talk about IR35.
Thanks. I'll just quickly wrap up our tax session with IR35. Next slide, please. IR35, or off-payroll labour and private sector. Just a reminder that it's coming from the 6th of April of this year, having been postponed by 1 year for large and medium businesses. So, where businesses are using contractors, for example, you have to look at their status and whether they are deemed to be workers, and therefore, for tax purposes, have an employee status. And what that means is that businesses engaging those contractors will be responsible, if they are deemed to be workers, to withhold PAYE NICs, otherwise there'll be penalties. So I know in the insurance business, actually a lot of businesses, particularly in FS, financial services, that they have stopped using these contractors in order to take away this risk completely, or they stop using them, or they have brought them on to the payroll. So again, take away that risk. However, for a lot of businesses, that won't be a practical solution. So they have to keep on using contractors because for short term, or it's COVID, and that's a sort of short term fix. So that's the only sort of practical solution to their hiring. Whilst this is a fairly well trodden path, I'm sure a lot of you are probably bored to death of this particular topic, but it's something that you do need to look at carefully, and just look at your systems in terms of, when you use contractors, your onboarding systems, making sure that all the tests are gone through. And I would say actually that, we have had quite a few questions coming from insurance intermediaries. So if I give you a couple of examples of questions that have come to us, I mean, they would include where suppliers or contractors are indirectly hired. So through a supplier that itself uses a contractor, a personal service company, or an agency. Or where we have another situation where they asked about using introducers, so introducers that are paid on commission as well. So all these actually are caught by these rules and have to be looked at carefully. I'm not necessarily saying that you have to pay PAYE, but the point being is that that's something that you have to consider quite carefully. So really, I'll just finish by saying that please do pay attention when you're using contractors, and make sure you have the appropriate systems in place. Otherwise, if you don't withhold the appropriate amount of employment taxes, then you will be penalised. So I'll finish there and hand back to Alex. Thank you.
Thanks very much. So just a few quick questions. We sort of don't have much time, but we've got two questions for you, Tom, if that's okay. Tom Barford. Firstly, there's a growing view that PE ownership is bad for every industry, and those that really invest in, particularly because risk of lack of investment, asset stripping versus other things. How true is this in insurance, Tom?
It's a good question. It's a big question. I think, you know, there's always high profile examples of private equity sort of being in the press and not doing things that people think they should have done. I think specifically within insurance, I think, and particularly insurance broking, I think these private equity investors are obviously trying to make money. They're trying to make a return. I think it's largely a growth story, though. I don't think the specific, you know, platform companies with their sort of M&A investors, I don't think there's anything other than, you know, growing businesses top line and the expense base growing with it. And I think a lot of these brokers are building up the capabilities in terms of compliance and regulatory, which helps support customers, helps support customer outcomes, and they take these things potentially a lot more seriously and put more resources into it than smaller firms are able to. So I think, you know, that there are possibly some quite good things coming out of private equity investment, and particularly in their ability to invest in technology and do replacement, all those sorts of things. So I think it's probably good.
Jolly good. And then there's one very short one about what's your slide net revenue or sort of so net commission, or was it sort of gross commission?
It should be net commission, but I think, as I mentioned, I'd take those numbers with a big pinch of salt, and I probably wouldn't rely on that heavily.
Fantastic. Well, I think that's all we've got time for. But thanks so much for joining us this morning. And we will send around the sort of slides and the link through to the recording as well. So thanks to all of those that have presented, and thanks for joining us. Have a good day.